Hello, hello, everybody. I'm very excited to introduce our next keynote presentation here at the Planet MicroCap Showcase Vegas 2024. It's somebody who I've interviewed multiple times on the Planet MicroCap podcast, and we always do our annual, or actually it's like biannual of review and what's going on in commodity cycles, oil and gas. And he came from more of a generalist side to that, to these sectors. So I always find it very fascinating hearing everything that Josh has to say, not just about oil and gas, but everything on the investing front. So with that, keynote presentation with Josh Young from Bison Interests.
Great, thank you, Bobby. So I'm following a panel of lawyers, so I'll highlight the disclaimer. And the reason I'm here is really for a few things. So one, Bobby's been great. I've somehow built up a social media following, but before I had any followers, Bobby was willing to interview me, and we had some great conversations on his podcast and offline as well. And also, SumZero was helpful in organizing this, and SumZero helped Bison raise tens of millions of dollars shortly after we launched. And so they couldn't have been more helpful to us. They sort of changed the trajectory for Bison and allowed us to accomplish what we did. And so, a big thank you to SumZero. I'd encourage folks that aren't active on there to go check it out if it's relevant for you. Importantly, so I manage an investment fund. I'm the portfolio manager for it, and this is not an offering for the fund. The idea is that we invest mostly in small and micro-cap publicly traded oil and gas companies, and it's sort of a success story in terms of how we've been able to do relative to how small oil and gas stocks have been able to do. And an offering can only be made if you're an accredited investor and through a prospectus and so on. So again, this is not an offering. The idea is just to highlight sort of what's possible and what things look like in small and microcap land for oil and gas, as well as what things look like in oil and gas land. Returns may be shown, they may be incomplete. Please see relevant disclaimers like this one up here. So here's a brief overview of what we're going to try to address, and I'm going to try to do all of this in 15 minutes. So good luck. So just a little about me and Bison. So we've gotten some exposure. We had a few years of sort of phenomenal performance, 1 year of terrible performance, and that somehow sort of garnered some attention from Barron's and Bloomberg and so on. We launched Bison in 2015, and again, we focus on publicly traded oil and gas companies. So this is probably the most controversial slide in the sense of showing our net returns since inception in 2015. The idea for Bison was that oil and gas stocks had sold off after the oil price crash in 2014, and with my co-founder, we realized that there was an opportunity to be like the Bison and face into this storm of volatility, and in particular, the sort of facing the trends of divestment from oil and gas, as well as the challenges of running and launching an active manager, where, as other speakers have talked about today, and I'm sure others will talk about through this conference, there's been a large amount of divestment from active management and investment into passive management, and like Bob Rabati talked about, investment in private equity and so on. And so that's offered a really interesting opportunity from the buy side to be able to select individual publicly traded companies that outperform the broader set. And again, statistically, this is not very likely. And random walk down Wall Street and various academic research will show you that very few active managers outperform. I would argue, and part of the reason to share this is that it's actually maybe the best time to invest in publicly traded companies. I would argue potentially, particularly oil and gas, because when people turn off their brains and just put their money into passive management, that creates the opportunity to be able to go buy things that are undervalued. And like Bob was saying, I mean, he said it just so well, that it's not about buying value versus growth. It's about buying the companies that are seeing an inflection, that are that maybe had very low expectations and very disappointing results historically, but as they turn and as they generate additional profit and additional revenue growth and better margins, you end up seeing the market reward them for it. And again, it's not about, there's always the question of, oh, how is this stock going to ever revalue? Why do people care? And the reality is, like Bob was saying, that the valuation sort of takes care of itself. The business does well, the market eventually comes to it, sort of that aphorism, the short term, the market's a voting machine, and the long term, it's a weighing machine. So there's more on what we do. You know, we're active managers. We try to find individual companies that we underwrite as sort of individual special situations. We attend conferences like this, typically more focused on oil and gas companies. And again, the idea here is that there are these great opportunities at conferences like this to be able to find companies that may materially outperform their benchmarks, that may outperform their indexes. And really, as people move towards passive investment, there's increasing opportunities for increasing dislocations, which means potentially higher returns from the same sort of thing that people have been doing for hundreds of years. So again, we try to find really cheap stocks. We try to find those companies that are run by really good management teams. We look for assets that we think are really mispriced and are able to generate a lot of cash flow under favorable circumstances, and that are generally able to survive under less favorable circumstances. And then what we found is that this particular sector, small cap oil and gas, is so out of favor that there are often embedded catalysts that in some cases have already happened. There's my favorite recent story, which is a few years ago there was an oil company in Canada where they published their well results through their regulator, the oil and gas regulator up in Alberta, and you could see on the Alberta regulator's website what the production results were from the wells, but they hadn't press released them yet. I think they were waiting a certain number of days for the press release. So you could literally, if you just checked that regulator's website, you could buy the stock ahead of the press release. I even wrote an article about it on Seeking Alpha at the time, which was, people didn't like it, they didn't understand it, which was wonderful because the stock tripled over the next year. And again, that's not guaranteed, and past performance is not indicative and so on, but there are these great opportunities, and actually we found another one recently where similar, we're waiting on a company to get approval for something, and they got approval through their regulator, and it's on that regulator's website, so it's public information, we're able to act on it, and they haven't press released it. So just sort of wild things that just shouldn't exist, but they're there, and there's just these incredible mispricings which allow potential outperformance over time. And again, when more and more people sort of check out and turn their brains off and put their money in passive index funds, or put their money in private equity funds or private credit or so on, which is just not competing in this space, there's additional opportunity to catch these things, and there's more time. The downside is obviously the more time can prolong itself. And again, I mean, I feel like I'm just copying a number of things that Bob Rabati was saying, but there is some benefit to things taking time. There's downsides, which is that you can get impatient and you can get pressure from outside investors, and you can be told that you're wrong or stupid or worse. But the upside is you're able to deploy increasing amounts of capital into opportunities that are increasingly compelling as the market doesn't re-rate them, and then an eventual re-rating can be phenomenal. I think his story was a stock going from 40 to 4 to 250, and so there are these sorts of just tremendous return opportunities when people give up, essentially, and even I think in that case that was before people had really moved to indexing too much. So one of the, I guess this is an illustration of this. So we've published various oil market perspectives over the last few years at Bison, and often we're asked, hey, like, why do you care about this? So we published something about the Waha basis, which is the West Texas local realized price for natural gas, going negative. I think it was in 2021. And we published something also in 2021 about the TMX pipeline expansion in Western Alberta going over to the west coast of Canada, that would bring better pricing for local realized markets. And we published various other things. Again, these things sound very esoteric, not so exciting, but when you look at the returns that were generated from the individual stock ideas versus the broader market and versus the oil and gas public equity indexes. We used XOP in this case for that benchmark. There were opportunities just by understanding things that were really basic that in some cases it actually already happened or were sort of well known but just not priced in. There were opportunities by buying these things after it was already known, again, and public, to be able to earn multiple times returns relative to how the market performed. And again, just there's such enormous payoffs from doing the work and understanding the fundamentals of these sorts of companies. And there's just incredible opportunities, incredible sort of undiscovered gems, especially in the small and micro-cap space, and I would argue especially in oil and gas. So from an oil market perspective, so I was asked to share just a little bit on what's happening in the oil market. I get asked a lot, hey, isn't oil going away? You see these announcements from politicians, you see regulatory announcements, you see projections from government agencies and NGOs. And the reality is, if you look at just one chart on here, we tried to provide sort of a snapshot of how cheap energy stocks are versus their earnings and how little energy companies are investing, oil and gas companies in particular, versus how much they've invested historically and how much is necessary in order to invest to actually supply the market adequately and not send prices much higher. But if you just look at this chart on the left, on the top left, you can see that oil demand has grown pretty consistently over time with the exception of COVID. And so what we didn't show in this is an even longer time frame where there are various reasons for this, but in prior periods where there have been oil demand growth disruptions, you've actually seen growth afterwards at an elevated pace relative to the prior growth rate for oil demand. So we've seen that now. I think the IEA has revised up their demand estimates already twice this year for global oil demand for 2024. And if anything, they may be wrong still and too low. And I think the expectation is for government agencies and non-government agencies that are providing these forecasts, as well as the consultancies that get paid a lot of money to share these sorts of forecasts with a particular sort of focus, for them to underestimate oil demand globally and for it to outperform. This is driven both by faster growth in emerging markets for oil demand, as well as by less decline in oil demand, even in countries that have substantially electrified, like in Scandinavia, where their per capita oil consumption is something like 5 times the per capita oil consumption in countries like China and India. So we think it's really interesting to invest in oil and gas here because of that sort of persistent growth in demand, as well as the undersupply in the oil and gas space. And we think that the small caps are particularly interesting, again, sort of tied back to this conference and sort of what we're doing here, because when you look at a small cap company, if the earnings grow and the cash flow grows and the revenue grows, you should expect the market to re-rate it. But in commodity producers, there's even more pressure on that re-rating because you need more investment in order to get enough supply to suppress price and to end the commodity cycle. And so we think it's really interesting to invest in companies that are necessary in order to sort of end the cycle and to buy them at very low valuations where there are very low expectations that are built into those stocks. So we think it's interesting to invest in small caps that are mispriced, but we think that the commodity producers in particular the companies that have been the marginal incremental suppliers of the commodity, we think they're the most interesting when they're at low valuations because they have this opportunity to re-rate, and they sort of need to re-rate to attract enough capital to get enough investment, to get enough supply to eventually end the cycle. And you sort of can't end the cycle until you get enough supply or until you kill demand. And again, like we've seen with oil, demand growth has been persistent, and frankly, it's been higher than consensus expectations for many years now. So again, just more on why we think oil and gas stocks are so compelling here and why it makes sense to take an active approach and select individual oil and gas stocks rather than sort of outsourcing our brain and just buying an ETF or an index fund. So again, there's more on mispricing on oil and gas stocks. It's pretty interesting in terms of how cheap small cap oil and gas stocks are versus large caps, and how cheap individually selected oil and gas stocks can be versus even small cap indexes. So there are real mispricings. There's different ways to express this. This one we showed in the context of what the implied oil price is. Investment banks and others will do these sorts of analyses, and I think this one's a little dated. It's just meant to be illustrative of a potential sort of opportunity. But they'll evaluate, if you use a set discount rate, what oil price is priced into various equities using a sort of discounted cash flow analysis. And so using that sort of analysis, I think, I'm forgetting which investment bank or research provider we leveraged for this one, but it just shows sort of how extreme a mispricing you can find, and that's, again, the cheaper a stock is, the more potential upside there is if you can hang on and if the company can hang on as well. And then, it is really interesting to look at what happened over the last cycle for oil and gas, but I won't push on this too much. I think it's really interesting to see just how cheap oil and gas stocks got generally, and then just how out of favor the small caps are. And there's various companies presenting here, and some are in oil services or various other things. Most are not. But when you can find a sort of industry dynamic like this, where there's suppressed price and low valuations, in my experience and in studying markets over long periods of time, it appears that, over long time periods, it appears that this is very promising for potential future returns. So one thing I've done that I thought people might find interesting is I got control of a publicly traded oil and gas company in Canada in 2017. They let me on the board, and shortly after I became chairman of the board of that company, we refreshed the board, refreshed the management team. I negotiated the sale of $80 million of assets, and then we sold the company. I think this chart might be slightly off. I think we sold it up 20% from when I joined that board. Or maybe that's measured from when I became chairman. It was a couple weeks off. And the average company in that time, so we sold it up 20% from when I became chairman, and the average company in that time that was a direct comparable was down about 50%, and the average company that was of a similar size to this company that I became chairman of was down closer to 65 or 70% in that almost 2-year time frame. So there's a lot of opportunities in the sort of activist or suggestivist space in small cap, as many people are probably aware, and we've exploited some of them historically, and we may do that again in the future. Most of our stuff is less active from a governance perspective, but where there is an opportunity to potentially garner significant excess returns through governance changes, we don't shy away from it, and maybe more to share soon on that. So this is how you can find us, and happy to open it up for questions if anyone wants to ask anything.
So great charts, by the way. One thing that keeps haunting me, keep thinking about oil demand. Yes, I think the rebound from COVID is understandable, but countries like China, 25, 30, 40% of vehicles are EV, or at least new vehicles being sold are EV. I think US is slower than China, obviously. How do you see that affecting? I mean, it can't be that it doesn't affect at all. So what's the delta today, and where do you see 3-4 years from now?
Yeah, so I think the right way to think about these things are less on country-specific numbers and more on understanding sort of the phenomena of oil demand and oil demand growth. And I really like the framework of looking at what's happened to oil demand in countries that have significantly electrified their passenger vehicle fleets, like in Scandinavia. And when you look at the per capita oil consumption, it's radically higher in Scandinavia than it is in China. And some of that is because Scandinavia, the countries are very wealthy, and China is comparatively very poor. And some of it is that the energy intensity of life in Scandinavia is way higher, not because of climate necessarily, not because of whatever, but again, because of the sort of energy consumption associated with living as a sort of more wealthy person or wealthy society. And so there's various drivers of oil demand. Only 30% or so, I think, is from passenger vehicles. A large portion of oil demand is from petrochemicals, asphalt, various other demand sources. And I think what you'll find is that China's oil demand will continue to rise considerably over time despite their move towards electrification. And then one of the interesting stats that I saw, I think it might have been for last year, I'm not sure how it's looking this year, but they were still adding millions of gasoline-powered vehicles a year to their fleet. And so I actually see more of a risk from efficiency gains from hybrid vehicles at this point for China than I see from sort of a full electrification, again, looking at sort of the various challenges that countries have had as they roll out that electrification, and then sort of individuals' consumption preferences where, in Scandinavia, 70 or something % of people might have electric vehicles, but they might also own gas-powered vehicles and then use them for various things that maintain their oil consumption intensity. So again, it's sort of a long answer. The short answer is that people use oil for a lot of things, and the more money you have, the more oil you use. And there are billions of people that use a tenth or so of the amount of oil that Americans use, even Americans that have electric vehicles.
Thank you. This has been great. Question on the gas side. What impact have you seen on the power gen demand created by AI that might be transitioning to more natural gas or hydrogen that might have an impact on some of your forecasts for demand planning for the next 5 years? Thanks.
Yeah, it's a great and timely question. So we're more focused for Bison on oil because oil producers have shown a lot more capital discipline. And the gas market, especially in the US, I think the biggest single driver of it is just the dramatic well productivity gains in the last decade for shale gas wells and the substantial remaining high productive inventory, both of shale gas wells as well as shale oil wells that also produce a lot of associated gas. So the supply dynamic for oil is much more challenged, and for gas, it's much more robust. That being said, there is very rapid growth in power demand from AI as well as Bitcoin mining and various other data center type uses. They're way above trend, which is great, way above forecasts, and that growth rate is actually increasing, not decreasing. Just today, I think Amazon, and I shouldn't comment on their financials because I'm not an expert in it, but their AWS margins were up and their activity was up substantially. So that's just, I believe, core cloud. So that's just basic data centers and services around them that are growing very rapidly and very profitably without even considering the AI trend and the Bitcoin mining trend and so on. So yeah, I think there's a really powerful demand trend. My concern there is just that there's readily available supply that is highly economic at the forward curve. Maybe not today's price, but when you look out the forward curve a year or so, there's potentially returns available for those drillers to the point where they may continue to oversupply the market and then see uneconomically low pricing. So there's sort of this potential negative risk that I don't want to really take too much.
Thank you for the talk. Are you looking at geothermal opportunities that leverage the oil and gas infrastructure? There's been a number of articles written about that more recently, and it's potentially an emerging opportunity that looks really exciting.
Yeah, I don't think you're going to like my answer to that. We invest across sort of the energy value chain, and the best perspectives that we've gotten on emerging technologies have actually been from service providers, because they can benefit economically from various trends like oil drilling rig companies and other sort of drilling related service providers can make money from providing services on geothermal as well as on drilling for oil or natural gas. And the ones I've talked to about it have been very negative on it in terms of the energy efficiency, sort of the EROI. How much energy are you expending to get it versus how much are you getting back, and what's the payback period in energy terms. And so there have been some advancements, but those haven't changed those service providers' perspectives. And so one of the things we do that's, I think, really helpful is we try to not take too strong of a view on any particular discovery or technology or field or really anything from that sort of technical perspective. We have a large network of experts. Some of our LPs are experts in really specific aspects of the energy value chain. And so we'll sort of, it's not outsourcing that, but we sort of have this whole network that will sort of lean on pretty heavily for questions like that. So again, right now, the feedback that we've gotten has been pretty significantly negative on that. But again, new technology could potentially yield different results.
Thanks, Josh. Curious if management engagement is a core part of your investment process. Even if you think that the story's not broken, but maybe it's cheap, is there still a requirement on your firm's part to engage management, maybe shortly after taking an initial position, or maybe prior to, or maybe you can talk to us a little bit about that. Thank you.
Sure. So one of the great things about the divestment from active management and the move towards passive is that there's very few people that actually go and talk to management teams of public companies, particularly in oil and gas, particularly, let's say, sub $1 billion market cap. So there's great opportunities to chat with companies, even if a company isn't particularly relevant for investment today. So we've known the management teams of companies, in some cases, for years before investing. And actually, that's sort of my preference, is to get to know people for a while before actually putting capital at risk. So we don't have to, but in many cases we'll know them ahead of time. And then I don't know if this is a brag or a humble moment, but probably rank as one of the most annoying shareholders of any of the companies that we're invested in if you went and asked the CEOs or the IR people at those companies. So we do engage pretty significantly. And one thing we found in common among at least some of our positions is that they tend to be really good at running their businesses and not so great at interacting with capital markets. And so that's been one benefit of doing stuff like this. We were careful to not mention any individual public companies in this talk, but through social media and through other forums, it's helpful, I think, to be able to find a weakness like that in a company and be able to sort of add a lot of value through, at least I think it's adding value through doing that sort of thing. So I think there are these opportunities to engage with companies, and in some cases, unfortunately, it's necessary to do a lot more than that in order to unlock value. And again, we're actively working on at least one of those right now, and can't share too much more about it. Thank you.
Hi. You told us about your success story. Just real quick, in the last 5 years, can you tell me a story about one of your turkeys where you got it just flat out wrong, made a mistake, and what you learned from it?
Sure. So Bob, in a response to Andrew's question, shared a company where he made less money. I'll share a company that I just lost the money I left in it. So Razor Energy. It was a high-cost oil producer. We tend to structure our portfolio where most of it is in companies that have ability to withstand significant commodity price volatility. I think we might have actually had no bankruptcies through COVID. We sized up Razor it was still a very small position, but in 2020, after oil prices had gone negative and were starting to rebound, and the theory was that they had the most commodity price leverage of almost any oil and gas producer, just because they were producing so much oil relative to such a small market cap. And they also had a power gen project, which was pretty interesting. And unfortunately, their costs grew almost as much as their revenue grew as oil went from 40 to over 100. And then when oil prices fell, they weren't able to sort of navigate that environment, even with selling their power generation. And so we were able to sell some of our position at a much higher price than we paid for it, and then the rest of it ended up as a zero. So that was very painful, and sort of a small position for us because of that risk of a zero, sort of in that high risk but high potential return portfolio. And in the meantime, it went, I talked about it on Bloomberg, like Canadian Bloomberg TV in early 2021. It was at 30 cents and it went to $4 or so, and then all the way back down to like 15 cents and then got delisted. So it was painful. It was a good lesson, and I think we might have still made money on it from some of the sales in the $2 or $3 a share range. But in the end, that's not, you want to own things that improve over time, that don't sort of get worse over time. And as it was getting worse, we started to sell some, but not enough and not fast enough. Great. Okay. Well, thank you guys all for coming to this, for listening to me talk, and look forward to catching the rest of the conference.